Hi everyone, welcome to our second money management session. Thank you for joining us today. So what we have here today that we're going to go through is managing your finances and investing strategically. Here at O'Brien Financial Advisors, we provide for holistic financial planning advice that will help you create your ideal life. We do this by understanding what you want to achieve and work with you to tailor a plan to suit your unique situation and individual needs. My name is Tracee Pang and I'm a financial advisor here at O'Brien's. So before we start, we're just going to go through a little disclaimer here that this is general information only and does not take into consideration your personal circumstances, financial situation, and needs. And we have Lisa here today as well to help with any technical issues. I'm just going to turn on my camera so you can focus on the information. So what we'll go through today is a real life case example of how we've helped our client. We go through differences in investment returns over time, focusing in cash, Australian equities, and international equities. And we have also dollar cost averaging, which is a strategy that we usually use for our investments plans, and the benefits of cash flow modeling. So, with financial planning, it is sometimes considered as a non-tangible assets. So sometimes it's hard for people to understand the benefit of advice in the short or longer term. So here's a real life case example of how we've helped a client. Client name's Jack, just obviously name's been changed. They've come to us with some goals here, and the goals are to receive advice on approximately $10,000 on available cash funds, wanting to invest the funds as well in line with his balanced risk profile. I'll go through that further in the next few slides. Wants to understand his net position in 4 to 5 years' time, and wants to understand the cash flow position as well. And while he's able to save at the moment, to consider a regular savings plan. So then while he has the capacity to save while he's living at home as well. What we did was that we invest $10,000 initially, and then with cash flow modeling and also assisting with budgeting, I identified that he was able to save $1,000 a month. And we invested them in multi-managed funds as well, in line with risk profiling. So with investment preferences, we decided on multi-managed funds because he just explained that he preferred a simple investment approach, which is he wants to set aside funds and not look at it. With regards to risk profiling, this is where we ask clients some questions to understand their investment preferences and also understand what their understanding of the market is and how they would react in certain circumstances. This is to identify a person's risk tolerance and investment timeframes as well. Because sometimes, obviously, with a higher growth investments, you have to stay in the market a bit longer. This is how we came to the decision to invest him in some multi-managed funds. So in our last money management session, we discussed the common investment types, and managed funds was one of them. So we're going to do a little poll now, and just to understand the crowd's understanding of managed funds and how this works. Lisa, if you could just have the poll up. So based on the answers that we had today, that we have some with confident understanding of what managed funds are Some have basic understanding and some have no understanding at all. So a higher portion to basic understanding. So we'll just do a little recap on what it is. So managed fund is where your money is put together with other investors, and fund managers then buy and sell assets such as shares and bonds on your behalf. Okay, you don't own the underlying investments, you own the units in the fund. For example, a unit costs $2 and you're investing $10, you get 5 units of the managed funds. Some of the advantages to that is that it provides diversification. This is where funds are invested across different asset classes such as Australian equities, international equities, property, infrastructure, cash, and fixed interest. And it's managed by experts because they're managed by fund managers that looks at the data every day. Some of the disadvantages of it is that there are buy costs involved, such as the buy sell spread. There's normally 0.1% to 1.15% of what you're investing. There's ongoing fees, also known as management cost, because they're being managed by fund managers. And then there's occasionally a minimum investment amount required, which is ranging between $5,000 to $10,000. So the next slide will go through what a best balanced asset allocation and earnings look like. So this is just an example of what it could potentially look like. Every fund has different one. So just note, although it's called balance, and this in our model, it has a 70% growth and 30% defensive exposure. That being 70% growth is exposure to Australian equities, international equities, property and infrastructure, whereas income funds or income assets are cash, fixed interest, and bonds. And in an example, like I said, we have 70-30, even though it's called balance, whereas if you looked at another fund, a balance could be more 50-50. If you looked at Australian Super, for example, that's 80% growth and 20% defensive. So just a tip to look at the growth and defensive assets as opposed to going by the name. So in this example, we have the return objective for our personal balance strategies, which is to achieve CPI plus 2.5%. We benchmark all our returns to the 3-year return and the 5-year return on the balance index. The recommended investment term for this kind of investment strategy is a 6 years time frame. And just a note as well that the investment time frame is not referring to the time in the market or how long you have to be invested. It refers to if there is a market downturn or a GFC or, for example, a pandemic, how long you have to remain invested to return to your investment position prior to the event. So in this example, from the scenario provided before, we had an initial investment of $10,000 with a regular investment plan of about $1,000 a month. And this was over 5 years. The annual return for the client was around 7 to almost 8% as well. So just in our last money management session, we talked about the historical low cash rate of 0.1%. That's for since November 2020 and then now. So compared to that, 7% is a decent return rate in comparison as well. So before we start on to the next topic, which is differences in investment returns over time, we have a second poll here on where your current savings are directed to. So we have 31% directing their savings to bank accounts. We have 13% who are investing it, and we have almost 56% doing both, which is a great result as well because you want to have that cash buffer. So what we're going through now is that we're going to look at the historical returns over three different asset classes, that being cash, Australian equities, and international equities. From the slide that I provided you can see that this is a cash return over the last 10 years. You can see from 2011, that was around 5% interest rate for cash, compared to a position where we're now at 0.37%. So although the past returns are not an indication of future performances, cash is considered a safe investment option. The perception is that cash is not subjected to risk of negative returns, provides liquidity and security. The risk, however, is that the returns are lower than the rate of inflation, which means that the same dollar now has less purchasing power than in the future. So an average of over the last 10 years, the returns actually around 2.4%, taking consideration the highest and the lowest peak as well. The next one we're going to look at is Australian equities. So in this one, you can see in 2011, there was about negative 10.98%. 2019, that was around 23.77%. And in 2020, that's when we had the pandemic, that was around 1.73%. Generally, Australian equities provide investors with higher returns than other asset classes, such as cash or fixed interest. It has potential for capital growth and generate income in the form of dividends. It allows for tax benefits such as franking credits and discounts on capital gains. The risks include exposure to market volatility and company risk. So just based on this example that I provided here, the return over the last 10 years is an average of 8.3%. And just comparing that to cash, which was around 2.4% as a reminder for that. Now looking at international equities. Again, in 2011, it's in a negative position, negative 1.91. Surprisingly, in 2020, although there was a pandemic, around 10.54%. I think that's because some country got hit worse than others. You can see 2019 is around the highest peak of 26.81% in that market at that time. So in the Australian share market represents approximately 2% of the global market capitalization. Investments in international companies provide exposures to companies that are not available locally. It provides further diversification while allowing for potential for capital growth and income returns. The risk, however, in addition to what the Australian equities market would experience, would be also currency risk. So based on this example here, in the last 10 years, the average return was around 12.55%. So just a reminder, cash was 2.5, Australian equities 8.2 over the last 10 years, and international equities around 12.55%. So over time, the other asset classes tend to perform better than cash returns. The next topic that we're going to look at is in investment dollar cost averaging. So what is this? It is an investment strategy that we frequently use that works by dividing the total amount available for investment over a specific time period. The time period can be weekly, fortnightly, monthly. So in this example, we have a client with $60,000 investable funds. So this strategy works by dividing the available funds for investments over a period of time. In this case, we took monthly investments and we invested it over 4 months by investing $15,000 per month over 4 months. So what are some of the benefits of this strategy? It reduces bad timing of the market. So in the example I provided, investing $60,000 as a lump sum versus investing $15,000 over 4 months with market volatility. So in month one, for example, in the scenario one, if you invested $60,000 and the market dropped by -5% immediately, or even next month, the investment balance then drops to $57,000 almost immediately. Whereas if you spread that across 4 months, the risk of reduction is then reduced quite a lot as well. That's $2,100 that you will have to not make up. It also removes the emotional component of it because you're just setting up a regular investment status and you're not looking at it, you're not looking at the market going up and down. You have a plan in place. There are disadvantages to the strategy though, where the market increases, every dollar will purchase less units in the market. So in the last topic that we're looking at is actually the benefits of cash flow modeling. So similarly to the initial scenario provided, this client Jack is age 25, earning salary of around 60,000 per annum, cost of living around 40,000, currently living in a share house, has saved up around 25,000 and identified that he was able to save around $800 a month. So some of the common queries that we have from clients at that age is wanting to purchase a home in a few years, wondering how much they can borrow, and also wondering whether or not they can afford the repayments based on the current living expenses of $40,000 a year. So part of what we do as well is providing financial a cash flow modeling with this scenario to help the client understand whether or not what they're trying to achieve is realistic or not. So we'll just show you how that normally looks like. So you can see in cash inflow, there's the salary that's coming in, there's the living expenses home purchase, and the relevant income tax that's being paid from the salary. Having a $800 savings plan that we've directed to an investment portfolio, client has about cash surplus of about $157. In 5 years' time, by directing the funds to an investment portfolio in line with the balanced risk profile, it's able to have around 82,000 in 5 years' time to assist with the home purchase there. That's assuming around 603,000 is being borrowed because that's what he's able to afford in loan repayments as well. From this, we also identified that he'll have to adjust his cost of living to around $25,000 a year to be able to afford this $26,000 home loan. So this is what we recommended. We recommended the client to invest the $20,000 available funds and establish this regular investment plan of $9,600. Was able to identify that he was able to borrow around $600,000. $3,000 is the purchase cost that assisted with that purchase, and also assisted him in understanding what he can afford in cost of living. I mean, some people can live off that, some people might not, and will have to reduce what they're borrowing or might have to save up a bit more as well before they purchase. So how can we help you? We can help you by organizing a meeting with us to action this concept. And in our next session, it's on entering the property market successfully and securely. You get to hear from our panelists, which includes Rory from mortgage. He's a mortgage broker from Own Home Loans. We have Zeno Kobika from Viva Property, and we have Rebecca Pugh from City Pacific Lawyers. Then any questions? Lisa, if there are, can you just let me know?
No questions at the moment, Tracee.
Great. If there's any questions, please feel free to email us at o'brien@obbc.com.au. Thanks again for your time, guys.